I'm Paul Belshaw of Gene Daniel and Associates, coming to you from our world-famous headquarters in Tampa, Florida. Today we are discussing S Corporation stockholders' reasonable compensation in the form of wages. S Corporation compensation requirements are often misunderstood and abused by owner shareholders. An S Corporation is a type of business structure in which the business does not pay income tax at the corporate level and instead distributes the income, gains, losses, and deductions to the shareholders for inclusion on their income tax returns. If there are gains, these distributions are considered a return on investment and therefore are not subject to self-employment taxes. However, if stockholders also work in the business, they are supposed to take reasonable compensation for their services in the form of wages. And of course, wages are subject to FICA, Social Security and Medicare, and other payroll taxes. This is where some owner shareholders make the mistake by not paying themselves a reasonable compensation for the services that they provide. Some because they are not familiar with the requirements, and some purposely to avoid the payroll taxes. The Internal Revenue Code establishes that any officer of a corporation, including S corporations, is an employee of the corporation for federal employment tax purposes. S corporations should not attempt to avoid paying employment taxes by having their officers treat their compensation as cash distributions, payments of personal expenses, and/or loans rather than as wages. If the S corporation does not pay its working stockholders a reasonable compensation for their services, then the IRS generally will treat a portion of the S corporation's distributions as wages and impose Social Security taxes on the deemed wages. There is no specific method for determining what constitutes reasonable compensation, and it is based upon facts and circumstances. Generally, it is an amount that unrelated employers would pay for comparable services under like circumstances and based upon the cost of living in the area where the business is located. The problem here, of course, is that it is easy for the IRS to list contributing factors used by the courts in determining reasonable compensation and leave it to the corporation to quantify these factors into a reasonable salary, but still have the ability to challenge the selected amount later if an auditor, off the top of their head, decides the compensation is unreasonable. The IRS has a long history of examining S corporation tax returns to ensure that reasonable compensation is being paid, particularly if no compensation is shown being paid to employee stockholders. Of course, taxpayers cannot pick and choose a reasonable level of compensation to minimize taxes or maximize deductions. Therein lies a trap for taxpayers who do not consider the factors related to reasonable compensation. There are commercial firms that have the data necessary to determine reasonable compensation and specialize in doing so. These firms can be found by searching the internet for reasonable compensation. Even the IRS has employed these firms to provide reasonable compensation data in tax court cases. If you want additional information related to reasonable compensation, visit our website at genedanielassociates.com or call our New Jersey office at 973-831-6000 or our Florida office at 727-943-8822. Thank you for your time and have a wonderful day. God bless.